It is something that stuck out over the last couple of weeks, as the markets have really kind of levitated here near the previous all-time highs made on March 1st. To me, one of the other things that's really interesting about this commodity move is also the weakness in the dollar that we've had over the same time period. So all of a sudden now we're seeing weakness in China equity markets. We're seeing weakness in commodities. We're seeing a dollar that's not rallying. We're seeing rates here that are just kind of stuck, and they're not really signaling anything. They're not signaling the same things that the stock market is, about to make a new all-time high.
What those things are signaling are basically economic weakness, right? So, I mean, a lot of times when we take a look at commodity prices, what we're interested in is whether or not the dollar is strong, because what we're interested in there is it inflationary or is it non-inflationary? We saw that iron ore demand in China is obviously also weak. And when you see those types of things, that doesn't really bode very well if we're going to depend on that. We hear a lot about a reflation trade. Where's that reflation going to come from if economic growth in the largest markets is slowing? And I think that's one of the reasons why
people it's across the board, right? I mean, because we know that basically half plus demand of all those key items, industrial metals, that's the main thing, right? Not the softs, not cotton and cocoa and so forth, but it's zinc, it's nickel, it's rebar. If you look at the Bloomberg iron ore index of 65 leading steel companies from Nucor to Nippon, it's all rolled over. Copper as well, and oil, of course, has been in a funk for forever. The issue is it really important for idiosyncratic stocks like Amazon that just keep growing their business? Which is the message that's right. For instance, while the Shanghai is in trouble, right, and acting poorly, the Kospi is breaking out to all-time highs, and the two things that's tied to are semiconductors, which is an economic indicator, and shipping. So there's a lot of cross currents, but ultimately, I believe, and I think you're making the same case, that equities cannot keep diverging from the message of industrial commodities.
Look, if we are to believe that most of the softness in demand in the lack of growth comes from outside the United States, could there be a case made that makes U.S. equities look even more attractive, that in some way they are some sort of a safer haven than other equities
Except for the fact, and Carter talked about this last week, that those 5 names that are up 25, 30%, Amazon, Apple, Facebook, Google, and whatever, they're making up a disproportionate amount of our equity markets here. So it's really concentrated in a small group of names. And these were the same names, don't forget, back in early 2016, when the same sorts of risk assets were going crazy, meaning like acting poorly, commodities, rates, the dollar, that sort of stuff. What was going on? Money was pouring into those. They became this sort of safe haven trade. So they're kind of acting independent of global growth or growth here.
All right, well, let's get to the one commodity in particular that has gotten so bad that the chart master over here says it's actually good. What are you looking at?
That's, there's one of the great adages, don't catch the falling knife, or do dumpster diving, or stay away from weakness, but let's do a little dumpster diving here. Well, what are we going to talk about? We're going to talk about commodities in general first versus the S&P, and then I really want to zero in on silver. So what I've got, 2 lines, that's usually the start, right? We've got S&P in blue, and what we've got, of course, is the Thomson Reuters commodity index, equal weighted. So it eliminates the overweight in crude, and you can see here, obviously, this huge divergence between equities and perhaps the message of global growth and or China. Let's keep going. So I'm adding silver. Same chart, I've just added silver. So now, of course, silver jumps out, again, all on a 1-year chart compared to the other two. So let's take it away. Again, making the point that there's this big divergence between equities and commodities, all commodities of which silver is a part of that orange line. And then if you add silver, just how bad this has been. But the real point is to show how volatile silver is. Silver overshoots, silver undershoots, silver overshoots, and so forth. And so the issue is this current leg down due for some sort of reprieve? I think it is. All right. 14 sessions in a row down. That is a remarkable thing. In fact, this ETF, which was inception date in 06, has never had a 14-session decline. And today, it was up ever so slightly, just a little bit up. But I think that breaks the trend. And we're going to make the bet that the start is now that it's going to throw back. Let's look at a few charts. One way to look at silver is a longer-term chart, is that we've worked our way into this wedge, and often things get resolved. Now, what happened was it did. It broke out. But now it's failing. So the question is it going to fail? Well, if we extend this line, if I were to extend this line, there you have it. I think it's going to hold that. And so we're going to make the bet that silver is going to bounce, having been, quote, oversold. It's right back to where it started on the year. Not random where it is, yes, holding a level that's key. And then finally, let's just talk about something that I think is important. One of the great stories in all equity markets, the Hunt brothers, they tried to corner the silver market. They, at one point, had 195 ounces, 1/3 of the total global supply, and they were targeted themselves, actually, to stop this. And the commodity exchanges increased margin dramatically, essentially broke the Hunt brothers. Now, the bull would say that this is maybe all the way down to support and is going to bounce. The bear would say, wait a minute, if this is all going to be very symmetrical, we have this much more to go, that we're going to get down into here. I think it's over now. We want to play because of the 14-day down for a bounce, independent of the long-term picture of SL.
All right, so Chartmaster's playing for a bounce. How about you, Mike?
Yeah, I mean, I'm comfortable with that. You know, one of the things when commodities decline, if it's natural gas and injection season, prices decline because there's nowhere else to put it. When oil glut was in Cushing, Oklahoma, no place else to put it. But with silver, with a precious metal, it's a little bit different. You don't have that same dynamic. So I'm looking out to August and buying the 15.5, 17 call spread. You can spend 50 cents for that. Obviously, if it does continue to fall a little bit further, that's the most you're going to be risking. But a 50-cent pop from here would be very small for silver. If it goes anywhere back towards 17,
and just before, I mean, Dan, I'm weighing in, but what you said is like if it continues to fall, that's the key thing, because what if we tried this after 11 days down? Well, guess what? It went down 12, 13, meaning you're never quite sure when a bottom is in. That's why it's never a good technique to buy weakness. But at some point, things do mean revert. I'm going to stick my neck out. We're going to stick around and make the bet that it will.
I'm not fully convinced by your, I mean.
Well, there you go. That's probably why it's going to work. Not
You
to say
never
that you're right
know,
or wrong,
falling knife, it's never smart, it's not a good strategy.
One of the
because it isn't.
But one thing we do know for sure, and that is that it's moving sharply, right? Mm-hmm. So if you are going to do a trade like this one, there is an opportunity to actually make a multiple of the amount you're investing, and that's really the play here.
Listen, I think the idea makes sense. You're being contrarian here. The setup is something that hasn't seen in a very, very long time, if ever. What I don't love, and I'm going to say, I don't love August, and I don't love the tightness of the spread. And so the only thing I would maybe consider is if you wanted to buy a long-dated call, which is near the money, or is basically at the money, like that August 15.5, I might not sell that 17 call in August. I might look to sell a shorter-dated one. We would call that a diagonal calendar, or whatever you want to do. That's getting a little tricky for you at home. Just maybe consider buying that call. That's your defined risk right there. If the stock were to have a quick snapback, it was just trading at 16.5, 3 sessions ago, then you would look to sell a higher strike call.
Yeah, I mean, that call, though, costs 5% of the underlying price, and so it decays rather rapidly, and selling that upside call does mitigate that fairly considerably. And 17 is where it essentially fell.
Yeah, but it might. If the stock just jumped $1 right then, you know what I mean? Like, you're kind of stuck with this $1.50 call spread that's at the money.